Welcome to AM Best Audio.
Welcome to this AM Best briefing. Medicare Advantage, Challenges and Opportunities. I'm John Weber. Over the next hour, a panel of AM Best analytical staff, along with health insurance industry experts, will share their expertise, their insights, and their 2026 outlook on the Medicare Advantage business segment. We're going to meet our panel in just a moment. Now, we may mention the subject of financial strength ratings. A full explanation of AM Best ratings can be found on our website at ambest.com. The opinions expressed by our non-AM Best panelists are theirs and theirs alone and do not necessarily reflect the opinions of AM Best. Now, if you have a question or comment for our panel, please use the question feature on your screen and we will do our best to recognize it during our program today. And now let's meet our panel. Presenting today will be Julia Friedman, Principal and Consulting Actuary for Milliman. Julia, so glad you could join us today.
Thanks for having me.
Also with us today is Stephan Harris. Stephan is President, Government Markets, Healthcare Service Corporation. Stephan, thanks for taking the time to be with us today.
Hi, John. Thanks for having me.
Also with us is Bridget Mayer. Bridget is Director, AM Best. Bridget has been with AM Best for 20 years, predominantly working with health insurers. Overall, Bridget has 30 years experience in healthcare finance. Bridget, as always, it is great to see you.
Thank you very much, John.
And Bridget, we're going to kick things off with you today. Medicare Advantage has struggled to achieve profitability as of late, hasn't it?
Yes, it has. And we're going to go through our presentations today, and we're going to try and address that question and also talk about opportunities that remain with the industry. Even though there are challenges, there are still significant opportunities in Medicare Advantage. So this is our agenda for this next hour that we're going to be going through. I'm going to be starting with the insights from AM Best. And we have all of our expertise in our presentation. And you can look at that during the presentation. And then we're going to go over a little bit about AM Best. AM Best is a global rating agency widely recognized by the financial industry, and it is the only rating agency that is solely dedicated to the insurance and reinsurance markets. The company is also well known as a source of pertinent and timely research and insights in the insurance industry. So we're going to talk about the Medicare Advantage insights from the viewpoint of AM Best and as being an analyst in this industry. We have outlooks on our business segments. We started off for the first time last November, in November of 24 actually, putting a sub-segment outlook out on government programs, specifically Medicare Advantage and Managed Medicaid. At that time, we assigned the sub-segment a negative outlook. And it was mainly because of the increased utilization trends that were being seen in the industry, along with impacts from changes to the Part D from the Inflation Reduction Act, changes to the star ratings, or reductions, actually, the reductions in the star ratings, and then it was the changes in the risk adjustment payment methodology. Then when we started into 2025, we saw more broad-based things going on in the health insurance industry. And at that time, we revised the outlook for the health segment to negative. So it was building on to what we were seeing with the Medicare Advantage and the Managed Medicaid, but then also adding concerns with the commercial population. So as of right now, which we reiterated in November of 25, the entire health segment remains on a negative outlook. We are using AM Best research for these slides. Unfortunately, 2025 year-end data is not available yet, but we are looking for annual data through 2024. And as you can see in this slide, Medicare Advantage, which is the yellow or golden bar, has been a considerable contributor to overall profitability in the health insurance segment, where it did reach a high in 2020, and that was due to COVID, but it's generally been a reliable source of positive earnings. Now, over 23 and 24, we're seeing that the margin decreased and then it moved to a loss in 24. And then the green bar across here is the number of overall plans that are reporting a loss. So you're seeing over the last 3 years, so starting in 22 to 23 and 24, you can see a worsening in the number of plans that are reporting losses. Again, this is a look at the medical loss ratio for Medicare Advantage, this segment this line of business on its own. There is some variability between 2020 and 2022, and that has a lot to do with the impacts of COVID. But then you see in 23 and 24 where it is spiking up considerably. These are being driven by increased utilization and unit cost in the industry, among other changes that impacted their operating results, such as when I spoke about the changes to the risk adjustment program and also the Part D cost sharing changes. We did a little bit of dicing, and this is your medical loss ratio by company type. Overall, the trend from 22 to 24 is showing an increase for all different types of companies. But you do see that the highest loss ratios are going to be for your not-for-profits, and also your Blue Cross Blue Shield plans. They typically target a lower margin, and also they will have smaller populations. So they're going to be seeing it a little bit more sharply when the medical loss ratio increases. This is the medical loss ratio trends for the publicly tradeds. Again, you are seeing the trends is very similar across the board. They are all increasing. We do note that CVS Health did have a sharp increase between 23 and 24. That was out of the norm of the trend that we're seeing in this slide. And that is because it was reported that they had lost the 4-star rating on their largest Medicare Advantage plan. Through 3Q25, we're not seeing any abatement of the trends that we're seeing. However, they are becoming more of an expected versus on an increase. So they're maintaining a higher level without the big sharp increases that we saw over the past 2 years. Now we're looking, these slides we're going through, we're going to start looking at plans that are concentrated in Medicare Advantage, meaning they have over 33% of their premium volume is coming from Medicare Advantage. So you can see that when you have them with the blue one is both publicly traded and your not-for-profits, or you're excluding the publics, excuse me. You can see that they're profitable all the way along the line, and they remain profitable in 24. However, when we remove the publicly traded, you can see that they went to a loss earlier than everybody else. You can see that the loss for those plans started in 21. Through 21 and 23, that loss was manageable, but you can see that it was increasing considerably in 24. A lot of the concerns that we have going forward for the 25 results is that a lot of the trends that were emerging in 24 were back ends towards the latter part of 24 after 25 bids were submitted in June. So we think that that the results in 25 are going to reflect that some of this trend was not priced into the plan design and also the rates for the 25 period. Now, this is looking specifically at the star ratings. Star ratings had, as a weighted average of enrollments, reached a high in 2022 at close to 90%. So that is very remarkable. So 90% of Medicare Advantage members were in a 4 or 4+ star plan. Those plans, when you have the 4 stars, you have your 5% bonus. That payment is used for the benefit of the member, either through cost share reductions, premium reductions, or increased benefits. So you saw that there was a very big effort for attaining the 4 stars. That has deteriorated going through to 25, down to 62%. Part of that has to do with how CMS designs the program, and they have raised the bar over the years on what it takes to get that 4 stars. And going into 2026, when we were looking at some of the information, the averages, we see that the average is going to be below 4 on average. So we're expecting that weighted average enrollment will be lower than 25s for the 26 payment period. So this is going to be Medicare Advantage concentrated plans also. We're looking at capital surplus. We're looking at paid-in capital, and then we're looking at the underwriting losses. Capital and surplus had been slowly growing and maintaining an upward trajectory, but so had paid-in capital. So your paid-in capital is more than likely offsetting underwriting losses and funding any growth for plans. So you do see that there is definite moderate capital growth, and also there is increased need for paid-in capital to support this line of business. Now we're going to look at some of the concentrations of MA and the impacts on some of the aspects of the AM Best ratings. Our balance sheet starts with our BCAR and our balance sheet assessment. So we are seeing that BCARs are being maintained at a pretty steady level, even though there are changes or challenges in the Medicare Advantage business segment. And that has a lot to do with the paid-in capital that is being provided to the insurance plans. When we look at the balance sheet assessments, you can see that MA raters, a lot of them still have the strongest balance sheet assessment. And so, a lot of them will balance through all of the different, assessments. But you can see that just because you're concentrated in MA does not preclude you from having the strongest balance sheet assessment. Operating performance, you're going to see a little bit more of a challenge for the MA concentrated plans. This is backwards data. This is for ratings through, we pulled this, I think, for ratings through September. So you can see that the MA writers, there's going to be a little bit more in the marginal and less in the adequate. Although they may have a concentration in MA, they are writing other business, which could be profitable, which will impact also their assessments. Business profile, most plans have a neutral or favorable business profile. Majority of our rated entities are not writing just Medicare Advantage. They are writing a broad spectrum of business. So that could be one of the reasons why they're going to be more of a neutral or favorable. If you are highly concentrated in Medicare Advantage, that could impact your business profile, but business profile takes a little bit more time for it to be built in and recognized in a business profile assessment. And with that, I'm going to let John ask me a couple questions.
Terrific presentation, Bridget. And yes, we do have some questions for you, starting with how much are the challenges with Medicare Advantage contributing to the negative outlook for the entire health segment?
It is in part, but it's not the overriding theme. The overriding theme for us kind of had been when we saw that the negative trends that we were seeing in Medicare Advantage move into the commercial population also.
Bridget, why is the deterioration in Medicare Advantage underwriting results so pronounced?
First, the business is entirely underwritten. Commercial business is going to be split between underwritten and self-funded. So we do see it because it is a large piece of at-risk business for insurers, and it is a growing business segment. More people are aging into Medicare Advantage than ever before, and they're aging into Medicare, and then more selecting Medicare Advantage plans also. So it's a growing business segment. So the trend is just being more pronounced.
Bridget, how much do regulatory changes impact underwriting for Medicare Advantage? It is one of the segments that is highly influenced by some regulatory actions. CMS is the agency where you have your bids are submitted, and also there's the benchmarks that come from them. Then they also are they drive the Star Bonus program and also the risk adjustment programs, and they also approve the overall average rate increase for the business segment. So it is highly regulated. Star ratings have been consistently declining. Is there a scenario where they can improve materially?
I think so. I do think it's going to take there is, I think it's out for comment right now with CMS that they are looking at that to be redesigned for in 2026. So there is a possibility that this new way of it being redesigned could be beneficial to the insurers, but it is a difficult one. Part of it has to do with member satisfaction, and given all of the plan design changes that we've had that came out from the open enrollment and the rate increases, I have a feeling that the member satisfaction piece of it will be challenging for the plans this year.
All right, finally, Bridget, can a concentration in Medicare Advantage impact a company's ratings?
It could. It definitely could, but it depends on how they manage and balance the business against their other lines of business.
Okay, thank you, Bridget. Next, we will hear from Julia Friedman, a principal and consulting actuary at Milliman. Julia is widely recognized as a leading expert in the Medicare Advantage space, advising health plans, provider organizations, and investors on strategic and financial performance. Julia, we're looking forward to your perspectives on how shifting dynamics in Medicare Advantage are impacting 2026 plan benefit strategies and 2027 outlooks. With that, Julia, the stage is yours.
Thank you so much. Quickly wanted to orient everyone on this slide and include some numbers that we're really proud of. If you don't know Milliman, we have a lot of presence in the Medicare Advantage space. We're doing almost 70% of the Medicare Part D bids, so PD plus MAPD, and we do nearly 50% of the Part C and Part D bids. And these numbers have held strong for a number of years. So really excited to be here and share some of the learnings we have on Medicare Advantage. Thanks. John, do you want to go ahead? Okay, so I was waiting for John to ask me a question, but I think the first question he was interested in is on utilization trends.
Yep, from your actuarial lens, with utilization trends are proving most structurally challenging, where plans are as we enter 26, building off the 2026 bid cycle.
Sounds good. So I'll get to this slide in a second. One thing that we heard a lot of during the 2025 season when we're listening to earnings calls with the publicly traded companies, they're consistently calling out elevated trends across the physician, the outpatient, and the inpatient services. Thinking about United, I think it was the third quarter 2025 earnings call, they noted they were experiencing 7.5% annual trends in 2025. And so to Bridget's point, this is certainly more elevated than what we've seen in prior years. And then they also went on to say that they priced 10% medical trend into the 2026 bids, like double digit, which is really not something we have seen in the past. I believe that they said that the 10% was due to continuation of elevated care activity levels. Again, what Bridget was mentioning, no impacts from the fee schedule changes, and then continued expansion of aggressive provider coding and billing practices. So again, take for that what you will. There's multiple areas that they're pushing up that medical trend. CVS was noting this too, and you hear it in multiple other earnings calls. Anecdotally, I work with a lot more regional plans and these smaller plans that Bridget was mentioning. Anecdotally, seeing this again across a wide swath of the country as well. So that was one thing thinking about medical trends. The second item, which I will touch on, I think, in a later question, is plans putting pressure on the benefits, both on the premium side, both on Part C and both on Part D. So I'll tease that, get to that in a bit, but there's definitely changes that we're seeing in terms of what's out there for members to be shopping on. And so getting to the slide that I have here, this is outlining Part D utilization trends that we're seeing through the first part, I believe, of 2025. 2025 was the first year of the Inflation Reduction Act, the IRA. So we saw the full year of the benefit redesign for Part D underneath that. This consisted of mainly having a $2,000 maximum out of pocket on drugs, which we hadn't really seen up until this point. It was kind of a continuing structure all the way up for anyone who was buying some of those specialty or high cost drugs. And so what we're seeing and what we saw through 2025 is a huge increase in trends. And we're seeing this across all types of members, but particularly the non-low income members. Low income members typically have much smaller cost share. They're subsidized by the government. So they're not as impacted by these maximum out of pockets, but the non-low income members weren't getting those subsidies. And so we're seeing about 2 times the trend at 24% relative to a low income trend of 11%. We also looked at this across multiple different cuts of the data. So the PDP market, the MAPD market, the AGWIPs. And you can see for the specialty trends for non-low income, in particular, you're seeing those in the PDP and MAPD spaces, both for gross costs and utilization. AGWIP is less impacted typically because they're already quite rich benefit design. So there's not as much induced utilization occurring there. But overall, again, this is very, very telling when we're looking at the first year of IRA. If we go to the next slide, this digs a little bit deeper into that non-low income portion, in particular for that bottom graph. But drawing your attention to that top left graph, nearly 10% of all Part D members are reaching the catastrophic phase in the Part D benefit design by June of 2025. And you can see in 24 and 23, this is about 3 to 4%. So we're seeing 2 to almost, I guess, over 3 times that amount reaching that MOOP. So they're effectively having that induced utilization. They're buying more. And because of some of the adjudication logic that we have in the regulation, non-low income members aren't actually paying that $2,000, actually paying only around $1,200. So definitely some nuances to be considering, and organizations need to be thinking about as they're pricing their bids, and that did price their bids in 2026. And I do want to mention CMS recently announced their balance model, which is going to be launching a new coverage of GLP-1 drugs in 2027 with a bridge program into 2026. And so we're working with a lot of organizations trying to understand the risk, the opportunities, the challenges with this. But there's a lot of change out there that's still occurring even post IRA when we're talking about trends. So utilization trends definitely both on the medical side, drug side, and then the benefits are things that are visible for me and my colleagues right now.
Julia, given current cost pressures, where are you seeing the most meaningful trade-offs being made in 2026 benefit strategies, particularly around supplemental benefits and member experience?
Thanks for that. So as you mentioned in my intro, this is really where I spend 100% of my time when I'm not doing the bids and advising clients on bid work. And so I lead, for a little bit of context, I lead the Milliman MacBat product at Milliman. This tool is something we've been developing over 15 years, and we measure the value added above and beyond traditional Medicare of each MA plan nationwide for the individual market. So you can look at this both at a micro level, but at a macro level is what I'm going to show you on the next slide. We talk about value added, and this value added is defined as, again, benefit richness above and beyond traditional Medicare, including any impact of member premium. So if you look at this graph and you kind of start at the bottom, this is where we were seeing the market back in 2023 to 2024 and how benefits changed. Obviously, huge changes were happening when we went 24 to 25. And as I was looking at this graph last year, I was predicting that we were going to see much more, I guess, bigger bars to the left of that 0 mark. And it turns out, that did come to fruition. This is for the general enrollment market, so non-special needs market. It's very similar when we look at the dual market. They just have some different levers that are pulled. And if you dive down, I think, into any regional approach, you're going to see very similar markets. So while this is driven by the nationals because it's an enrollment weighted average, overall, I think this is very similar in many markets. What I think is interesting to point out here is that you're seeing continued pullback of those Part C benefits. That's that orange bar at the top. Continued pressure on Part D. That's the dark gray. And then what's really interesting to me is the light blue bar that we see. And that is the actual increase in premium that we saw between 2025 and 2026. This is the first year we've seen that. We have not seen MAOs adding premium or actually taking away $0 plans to the effect that it is increasing premium on the aggregate. We will likely see that come down. It might go negative when we get the numbers post AEP, and I know we're waiting on those probably in February this year. Members tend to want those $0 plans. They're very popular. So that may go down, but very interesting to kind of look at first blush and see those changes. If you go to the next slide, I can dig a little bit deeper into that orange bar. What this is doing is looking at some of the benefit degradations that we saw, looking at, again, some of those national payers, and looking at relative 2025 to 2026. So what is the 2026 number? That's the black text, and the changes from last year below that. Some of these benefits that we picked to look at here align well with some of the trend impacted trend categories that we saw earlier that organizations were talking about, the inpatient, outpatient, physician. So specialty, copay, specialist copays, right? That's very heavy in the physician segment. And you can see high trends, and we're seeing many payers, definitely making changes to kind of combat that through their benefit strategy. So again, different payers are taking different tacks to try to impact some of those trends. And when we look at other categories, we look at supplemental benefits, we're seeing pullbacks certainly in those, whether it's the richness of the category or taking away a benefit altogether, or number of visits you might be getting. All of those are typically coming down as we're looking at the various different payers and what they're doing. In the next slide, we are getting to Part D. So as I mentioned, I think that was a dark gray bar in the slide a few slides ago. That resulted in increases typically from those Part D deductibles. So you see the 2025 Part D deductible is in blue here, 2026 is in green. Again, looking at some major payers, all of them are increasing those Part D deductibles. That's very visible. Typically, these do only apply to brand drugs. So you're not typically applying that to the generic tiers. But again, still very visible for members as they're going out to shop. And we look at the brand tier categories. So we're talking about typically tier 3 and typically tier 4 is where plans are putting branded drugs, which typically tend to be higher cost. There's also a specialty tier that is for some of those, again, very specialty drugs, and that's always been on coinsurance due to regulation. But what we've seen between 24 and 26 is a huge shift in the MAPD market from a copay structure to a coinsurance structure. You'll see that we point out on the slide, about 90% of MAPD general enrollment plans now have coinsurance on tier 4. I think the exceptions are pretty regionally specific. I think it's mostly California and Florida. But you will see, throughout that table, there are a few outliers when we're looking at tier 3. That's where the red circles are. And then the green is indicating a change from 25 to 26. So a lot of organizations are leaning into this brand strategy. We talked about some of the maximum out of pocket and that greater of logic. Payers are benefited from using a coinsurance strategy on some of those brand tiers relative to a copay strategy at a very high level. There's certainly more formulary analytics and reasons you would want to potentially do a copay for growth or other reasons. But in aggregate, again, seeing a lot of pullback when we talk about Part D as well.
What actuarial signals should payers be looking at, and are you seeing success in using value-based arrangements, and how effective have these models been in mitigating medical cost trend volatility?
That's a great question, John. I think Bridget hit on a lot of those items earlier, right? Stars are obviously things to be looking at. Understanding, provider network is another, which I'll get into. Risk adjustment integrity, obviously the medical costs, obviously looking at MLRs. There's a lot of signals that are important to be understanding in terms of the forest versus the trees, understanding you versus your competitors, which I'll get into in a second. So I think that, yes, there's a lot out there, but ultimately to me comes down to really getting that data and really understanding what the data is saying, because there's a lot out there, right? You can't boil the ocean in MA. There's so much to be to understand, and so making sure you're really getting clear data and asking clear questions is going to be critically and continue to be critically important as we go forward. With regards to value-based care, I've seen anecdotally payers are still pretty anxious to get into VBC models, but you may not always have some risk-bearing providers willing to do the same thing and anxious to take on risks. So I've seen both sides of the coin on this. There are some organizations that work really, really well with other provider risk-bearing entities. They're able to realize healthier populations. They're able to create the correct incentives, and they're able to scale. But sometimes the ones that are fragmented, they're not as agile and they continue to struggle. In a recent earnings call, I think it was the Q2 2025 United Health call, they talked about their one of the risk arrangements, and they said some of their most mature value-based care cohorts, the ones that are from 2021 and prior, they're realizing margins of 8% or higher in the past year in 2025. And to Bridget's slides, that's a great position to be in when we're seeing some of the financials right now. But then they went on to say that their 2022 and 2023 cohorts only seeing about 2% margin, and the ones that joined in 2024 and 2025 are actually seeing negative margins. So what does that mean to me? I think it means that longevity, and maybe I'm preaching to the choir, but longevity is extremely important when we're thinking about VBC arrangements. Having those members attributed to you in the long term is really important to be able to get success in the VBC business. And from a risk-bearing provider, I think jumping into it without having the informatics behind it can make it difficult to succeed, especially in this current climate, especially when we look back to those 2024 to 2025. And ultimately, I would think about VBC. It's effective when you're. Sometimes it's hard to protect you when you have some of those broader trend shocks. Version 28 being a really great example of that. That's impacting everyone the same, and so having to adjust how you're dealing with version 28, for example, is one thing that you have to be prepared to adjust for as a value-based care organization. But it can be effective when we're really understanding some more of those cohort ages and certain contract designs.
Julia, when plans are reassessing where to lean in or pull back, what financial and operational signals actually separate markets worth fixing from markets that are structurally challenged?
Thanks. And I think I realized I forgot to go through a slide, so if we can go through the next one more, please. Thank you. So I think this is a great slide to kind of indicate the market dynamics that are happening right now in MA. And product design is really one way to address that. It is one lever. But when I look at this slide, what's pretty evident to me is that there are a lot of headwinds right now in Medicare Advantage. There's a lot of uncertainties, and you're not seeing as many tailwinds. One thing that isn't on here is talking about the rate announcement, and so that's something I want to touch on at the very last portion of my discussion. But the continuation of potentially higher benchmark rates will always be welcome, I think, in the market. But back to your question, when we're talking about reassessing where to potentially lean in or pull back or exit, I think it's first really important to understand whether the losses that organizations might be experiencing are fixable or are they structural. Because the margin that's based on broad-based medical trend changes, for example, sometimes that can be harder to adjust even with utilization management capabilities. That's a very different signal than one that is driven by a known pricing error or known benefit positioning. Those are more easily fixable on a year-to-year basis when we're talking about the bids. So, of course, understanding where you are from a financial lens, and as I mentioned before, knowing how the forest around you is behaving versus your lone tree as the payer, really can help contextualize. Are you the only one seeing this, or is everyone seeing the same thing as you? At Milliman, we have a lot of different data assets that don't just answer that right on the MLR basis. We can get into, is your network health appropriate for where you're at? Is your benefits appropriate for where you're at when you look at where you are benchmarked relative to the market? So looking at margin by service category, by geography, by benefit user type, one way that I work with organizations, and really trying to also better understanding some of those structural shocks that you might get, so like flu season or payment rate changes, whatnot. If we go to the next slide, one thing I think that is critically important to hopefully have understood in 2025 and to understand as we go into 2026 is there were a significant amount of plan terminations and service area reductions, or SARs, in the 25 and 26 markets. And about 3 million beneficiaries will be required to shop for a new plan in 2026. That's 1.5 times the number in 2025 and 10 times what we saw in 2024. So we're in a considerably different place in MA in 2026 than I think we were even 2 years ago. But 90% of the beneficiaries impacted were non-special needs members, non-special needs plans. So the SNP market, as we'll get to in the next slide, you can go to the next one, definitely less impacted. Organizations are leaning into those SNP-heavy strategies, both in the D-SNP and the C-SNP space. But there are, it is really important as a payer, again, to understand the market around you as to where those terminations might be happening, and how that might be impacting your business. And of course, I don't want to forget like those drivers outside benefits, those drivers outside geography, understanding risk or performance, obviously critically important, understanding quality performance, all those things. You need to drive the revenue side of the house if you're also trying to drive some of the cost approach as well. So those are things I think to be critically thinking about when reassessing, leaning in or pulling back.
So what are the trends to closely be following in 2026, Julia?
Yeah, so my very last slide tries to wrap that up. Sorry, go back one more, thank you. So one thing I guess I didn't touch on, but I think we're seeing a lot of is some of these organizational consolidation and affiliations. Stefan's going to talk a lot about that with his business. And we saw just another one last week. I think Mass Gen and Fallon were looking to potentially look at a consolidation. So looking towards 2026, if we will see more of those. I mentioned medical trend, RX and specialty drug trend will continue to be shifting, especially with some of these models that we're seeing put out by CMMI. SNP strategies will be critically important. The government is definitely watching this. They recently put out an RFI trying to understand some of the changes in the C-SNP space as well. So understanding how D-SNP integration efforts may be intermeshing with that, thinking critically about that for your portfolio. Benefit richness and premium dynamics, as you can tell, we have a lot of data on that, but there is just a lot of change that has happened in the last few years, and I anticipate will still happen into 2027. And members are going to be facing, continuously different choices on their type of plan design versus what they had prior. And then I mentioned briefly the rate announcement. I think that's going to be a really big thing that we're all looking for. An advance notice in a few weeks and the rate announcement in April. Are rates going to be enough to kind of temper some of these shifts that we've seen and how they've impacted beneficiaries? I guess we'll all see. But that's going to be a big question mark that will help everyone, I think, kind of get to a better level set on their strategy.
All right, Julia, before we move on to Stefan, a registrant viewer asks, how much impact does GLP-1 bring to the overall RX trend?
GLP-1s are a very large driver of the RX trend. We have, again, a lot of data assets that can help you identify that down to the payer and member type level. But yes, it has had quite a big impact when we're talking about the trends in the past year. And layering that on underneath the IRA, it was kind of like a double whammy at one time.
All right, thank you, Julia. Our final presentation of the day comes from Stefan Harris, who leads HCSC's Medicare and Medicaid lines of business. Stefan will discuss the opportunities HCSC sees in Medicare Advantage, including their recent acquisition of HealthSpring and their outlook for Medicare Advantage from a Blue Plan view as well as a national footprint. Stefan, you have the floor.
Thanks, John, and good afternoon, everyone. I'm certainly excited to have this opportunity today to provide you with just an introduction to HCSC, who we are, coupled with an update on the acquisition of the Cigna Group's Medicare Advantage business, MedSup assets, Medicare Part D business that we acquired in March of last year. So, John, as you mentioned, just a brief introduction. My name is Stefan Harris. I've been with HCSC approaching 8 years. I lead government markets for the company. Prior to that, I was the president of Blue Cross and Blue Shield of Illinois here at HCSC for a few years. And before that, I have deep experience and government programs, primarily in Medicaid here at HCSC, and prior to that with the large national Medicaid managed care company. So jumping into the presentation, HCSC, as many of you all are aware, is the nation's largest mutual health insurer. We're the 5th largest health insurer in the U.S. overall, and that's with 27.4 million members as of 12/31/2025. As an extension of our footprint, that brings us approximately $86.5 billion in revenue, and we manage about $150 billion of medical claims spend across the country. Our presence is anchored around our Blue heritage. So, historically, we've been known as a Blue Cross and Blue Shield licensee provider in our 5 core states. That's Illinois, Texas, New Mexico, Oklahoma, and Montana. HealthSpring, which I mentioned earlier, we acquired in March of 2025, has given us the opportunity to grow our footprint substantially. For Medicare Advantage, it gave us an additional 29 states plus the District of Columbia. And then when you layer on top of that MedSup and PDP, that gives us coverage geographically in virtually all 50 states. So we're very excited about the opportunity to expand our geographic footprint beyond our 5 core states, and all of that will bring to us in the future. We have a group business, which has about 14.8 million members. Our IFM, which is our Affordable Care Act exchange business, which has about 1.6 million lives. And then the government business, which I lead, which includes everything that I just conveyed as it relates to Medicare Advantage and our Medicaid book of business. So for Medicaid, we have about 1 million members, the vast majority of that being in Illinois, where we have 700,000, New Mexico, and Texas, bringing out the balance of that. I won't go through all of the details around the assets that we have to support our insured business that's on the slide, but I will take a second just to highlight Care Allies. Care Allies was an asset that we acquired as part of the Cigna MA transaction, and that provides provider enablement capabilities that we did not have to this depth and magnitude, particularly in the Medicare Advantage space. This enables value-based care for key providers, bringing care management capabilities, data and analytics capabilities, particularly around risk accuracy and star ratings. So for providers that are looking to take on risk in value-based care relationships with payers, Care Allies is key to enabling that capability. Next slide, please. So as we heard earlier, there's several headwinds that the market overall is facing, and we suspect we will continue to face throughout 2026 and into 2027. Largely regulatory shifts. One thing that we're closely monitoring is around risk adjustment, where there's some ongoing uncertainty. We're going into year 3 of V28, which we heard a little bit about earlier. In addition to that, there's been some discussion from the administration and CMS about ratcheting up RADV audits and what that means. We're sort of in a holding pattern right now for CMS to release its schedule on how it plans to more aggressively pursue RADV audits. We know that there's some litigation that's out there that impacts the extrapolation methodology associated with RADV audits. So those are the types of things that bring some uncertainty in the risk adjustment space. We feel pretty good with how we're positioned in that regard. Just understanding, HCSC historically has had a strong culture of compliance. We have a strong relationship with CMS, and we feel as though we'll be prepared to quickly pivot to whatever the ultimate methodology or approach will be from CMS. Also, from a STARS perspective, we heard, there was proposed star changes to the program as it relates to about 12 star measures. And we're monitoring the impact and what will ultimately be implemented. We feel positive by and large with the proposed star changes. But obviously, stars is a top priority for us as a payer because of the incremental revenue that it provides, allows us to provide better supplemental benefits for our members. It also allows us to better support our members in meeting their wellness and broader needs, and helps to better stabilize our financial performance in the long run as well. So STARS performance is of critical importance for us. And then we heard about CSNPs earlier. There's still some uncertainty as to where CMS will align its policy as it relates to the significant growth that the industry has seen in the CSNP area. Their intent, over the last few years, as they have looked at DSNPs, is to really more favor those payer relationships that also have relationships with state Medicaid agencies. And there is a possibility that they could better align the CSNP requirements such that you have to be essentially a Medicaid contractor in order to have CSNPs. There are always exceptions, but we're actively monitoring that situation. We haven't been as aggressive in growing our CSNP footprint, so we don't view this as a material headwind in the short run. But obviously, we are looking at CSNPs strategically as an opportunity for future growth. Overall, we view the market in the long run as being positive. For HCSC, it is a strategic priority for us to participate and have products available for members and beneficiaries at all stages of life, and growing our geographic footprint to provide Medicare Advantage allows us to better provide and better execute upon that strategic priority. We know that the Medicare senior population continues to grow as we continue to age as a country. And all of those things, we believe in the long run will be positive for us. And we're excited in the long run at the opportunity for us to grow our Medicare Advantage business.
All right, very good, Stefan. Thank you so much for that presentation. We do have a few questions for you.
Well, John, before you go into that, there are a couple of maybe two additional slides I want to just cover very quickly.
Go right ahead.
Yep. So I want to talk a little bit about the acquisition in and of itself, because as I mentioned earlier, pre-acquisition, HCSC had about 1 million members, tightly concentrated in our 5-state geography. And our focus at that point in time was really maximizing our service opportunity, our service area and growth opportunity within those 5 states. The acquisition of Cigna's Medicare business took us to 4.5 million members through adding on a significant Med Sup population and PDP business, along with the MAPD membership. So having a national platform allows us to better take advantage of scale as a company and as an enterprise as to who we are. It allows us to provide a differentiated solution around whole person care, local density and focus in communities where we have an overlapping service area. So particularly in markets like Illinois and Texas, where we've had a presence from a Blue perspective going back, almost 90 years or over 90 years. We really have the opportunity to leverage our deep provider relationships, our employees, our stakeholder relationships, et cetera, in a way that we feel is a key differentiator. And then the other component that I really touched on a little bit earlier is really leveraging our BBC capabilities. We really feel as though through Care Allies and the strong HMO chassis that existed by way of the acquisition with HealthSpring, it really positions us where the market is right now, which is really going through a strong pivot from PPO, in particular $0 PPO products, to HMO related products. And so we feel as though we're in the right place there. And then the last slide. So just thinking about where we are and where we're going and as our outlook, as a company, we are approaching the 1 year mark post close of the transition, and we are aggressively continuing to execute on our integration efforts. We're making strategic investments in key area to leverage the scale that we have, and that includes investments in AI where it makes sense, as well as looking strategically at where there are opportunities to better enable VBC capabilities. We're also looking to optimize our member experience to better drive health outcomes. And that really equates to how do we improve overall Stars performance. So looking at those key member experience measures, making sure we're being very mindful of those types of benefit changes or provider network disruptions that would impact the member, and being very proactive in that regard. And then responding swiftly to policy and regulatory shifts that I discussed earlier that we will be experiencing throughout 2026. And then looking for sustainable growth opportunities in targeted geographies. And that includes rationalizing our Blue and HealthSpring brand, and optimizing the presence in overlapping geographies like Illinois and Texas. And then, looking very strategically across the broader geography at how we're positioned and where those opportunities are for growth. And that's it.
All right,
So,
ready
John,
for some questions, Stefan?
I'm ready.
All right, from your local Blue plan perspective, what market dynamics or member needs are shaping where you choose to compete and invest in Medicare Advantage?
Yeah, well, as I sort of mentioned earlier, we're looking at this in a couple of different ways. As we look at our expanded geography that we have, across the 29 states plus DC with HealthSpring, we are taking a very disciplined approach and, really stratifying our geographies in ways that help us to determine our growth markets that we're very well positioned and have favorable economics. We have good network relationships and network partners that really give us a right to win. We're also looking at those markets that we want to defend. So those are those markets that have those similar economics, but may have higher degrees of competition with our competitors. And then we're looking at those markets where we may be subscale or, maybe margin challenged. And that could be for a variety of reasons. We just don't have the membership to scale. We may not have the provider relationships. Could be a combination of those things along with the competitive profile in those markets. And given the market dynamics that we're experiencing as it relates to medical cost trend, and rising utilization and regulatory policy uncertainty, we're being very disciplined as we think through our future positioning and where we want to make our investments as it relates to those markets and how we've stratified them.
As HCSC balances a strong local presence with a growing national footprint, how do you think about scale versus local market customization in Medicare Advantage?
Yeah, it's something that is very important to us because given the current market dynamics, we believe that scale matters. And one of the positives from this transaction is that it has given us the opportunity to leverage our capabilities, whether it's legacy HCSC capabilities that may exist with our group or IFM or pre-existing government business or our HealthSpring business, and scale that across a broader base of membership. So whether that's our competencies that we have in claims and customer service, our network management capabilities, as we talked a little bit earlier, our VBC capabilities that came by way of the Care Allies relationship. These are things that we're aggressively working to scale across our entire book of business where it makes sense. At the same time, we're optimizing our local approach. So if we look at Illinois and Texas, we're looking at how we best leverage our Blue brand and our HealthSpring brand in those markets. And taking a very structured approach in understanding how our members react and what's most attractive to our members as it relates to those brands. This also positions us from a product portfolio perspective to look at products such as our D-SNPs, and I mentioned earlier C-SNP markets. And we have the ability to leverage our scale as a company to strategically grow, and then leverage our size as it relates to national benefit providers and vendor negotiations.
Stefan, what role do provider relationships and care coordinating play in differentiating HCSC's Medicare Advantage offerings in an increasingly competitive environment?
Yeah, as I referenced earlier, having a strong network partner is of critical importance. We think as the market has made its pivot from just broad PPO to more HMO, traditional HMO type of products, having tight relationships, anchored partners is really key for those markets where we want to grow or where we have historically been well positioned and we want to defend our current presence. From an HCSC legacy perspective, we've always have considered ourselves to be strong partners of choice when it comes to our provider partners, and we want to make sure we maintain those relationships. And then, from an HealthSpring perspective, as I referenced, we want to really maintain our strong HMO chassis. And that really, at the heart of that, is key, strong provider relationships with strong care coordination that have strong relationships with members. And we think that will be the model that will lead to our strategic and overall financial performance success in the foreseeable future.
Speaking of the future, Stefan, looking ahead, what do you see as the biggest opportunities and the biggest challenges for Medicare Advantage plans?
Yeah, well, there are a couple things that I think we've already discussed that I do think will continue to be challenges for us into 2026 and 2027. Emerging medical cost trend is something that I think we'll need to continue to monitor. Also, the uncertainty as it relates to policy and the regulatory landscape. The opportunity is sort of what I characterized earlier. Right now, our ability to execute on our integration strategy, our geographic strategy and targeting areas for sustainable growth, in an overall marketplace where Medicare, and seniors continue to age and the Medicare population will continue to grow, we believe in the long run will lead to opportunities for us to be successful in the long run.
Stefan, we have a question from a viewer who asks, in the Part C space, what type of services are generating an elevated trend in 2025?
I'm sorry, what was that? I heard the last part about what's generating elevated trend in 2025. I didn't hear the first part of that question.
Well, I may have lost that question.
I think it was for Part C, what is generating the elevated expenses?
Correct.
Yeah. So I think it's no different than what we're seeing across all of our lines of business. We're seeing increased utilization associated with outpatient surgeries. Oncology and specialty drugs are huge drivers of the medical cost trend.
All right. Well, this has been a great conversation today. Bridget, you get the last word. Any closing thoughts?
As we conclude, I just wanted to say that, their challenges are going to remain for Medicare Advantage, but from my experience, health insurers are highly adapted to a changing operating environment. It's probably one of the industries that you can say that no 2 years are ever the same. But opportunities remain for this segment, and it is one of the only segments which has the potential for real enrollment growth. So it is one of those segments that I think that the industry is looking to for profitability, for the future, for where insurers are going.
All right. Thank you, Bridget, and thank you all of our panelists for an outstanding presentation here today. We would like to let our viewers know that we will have a full replay of this briefing posted within the next day or so. We'll have a full transcript out within the next week or so. For AM Best, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.